Today I'm coming to you from 90 Gold Street. This is a one bed, one bath with a balcony and amazing views in a full service community. There's 24-hour doormen, there are laundry in the building, and recreational and gardens for the community. All for the price of $635,000. When you are purchasing in New York City with a mortgage, the lenders look at two things. Not only your financials and your qualifications, but the building's financials and qualifications. Most banks will qualify a building based on whether or not it qualifies for Fannie or Freddie financing, which is government-backed loans. Those buildings are called warrantable buildings, and the ones that are not eligible for those government-backed loans are called non-warrantable buildings. So there are going to be some changes in the next year to the requirements that the buildings, specifically condo buildings, not co-ops, would need to have in order to qualify for Freddie or Fannie backed loans. And I'm going to go through some of those changes. So let's start with the good changes. One of the new good changes is that new projects that are under 10 units will not need to be reviewed. And the old limit was 2 to 4 units. So that is a good change that is coming. Another positive change is the 50% ownership requirement, which is basically where it can't be more rental units or investor units than owner units. So that has been removed for established projects. It's still going to be relevant in new projects. So one of the bigger changes is going to be the limited review process is going to be eliminated, which allowed the banks to get approval without requiring as much documentation. But now that has been removed, so banks will need to go through all the required documentation in order to qualify for Fannie and Freddie loans. So the biggest change that will have the biggest impact is the reserve requirement, which is going from 10% to 15%. So not only will this affect people who are looking to purchase in condominiums, but it will also affect current owners because if the building's reserves need to be built up, if any capital improvements need to be done to meet insurance requirements, that's all going to fall on current homeowners in these buildings that need to get their finances up to snuff with these new requirements, which could mean assessments, common charge increases, and the like. If you have any questions on how these changes could affect you as a current condo homeowner or a potential buyer in the future, feel free to reach out. As always, I'm here to help.